The question is why Wall Street believes that people who purchase gold at or around the levels of 5,200 may actually lose their entire investment. Pay very close attention. So Wall Street sees the past and tries to predict the future. The previous 40 to 50% drop in gold was not a surprise. It was actually something very expected. If you look at over here, the historical norm in sell-offs after the gold makes new all-time high indicates that gold usually drops between 40 to 50%. If you look at the example, when the gold for the first time hit the levels of around 3,000, the pullback was down below 2,500. If you look at the current levels of new all-time high of 5,200, Wall Street sees that there is a risk for potential loss, pushing the gold down to 2,800 in probably one of the worst case scenarios, indicating a loss of around $3,100 for people who purchased at the peak. And again, remember, all of these losses will be contributed to different individual and institutional investors who have a cascaded liquidation prices. If gold goes down 3%, a lot of the funds will actually sell their position. They will be forced to close their position. And this is very important because remember, at the end of the day, most of the big investments or big bets are leveraged bets. They're not bets made with the own funds of the company. Also remember that there is alternative trading systems that have a preset risk management, which means at any given point, if the asset that the funds are allocated with drops 3%, 2%, 1%, the algorithm will execute a particular strategy, sometimes involving a couple of different decisions, which could be selling the underlying stock, selling the security, selling the actual futures, which could be in the precious metals market, and hedging with something else. Sometimes they even cannot make a clear decision because nothing looks good or fresh for rebounds on the market, so the algorithm decides to sit on the sidelines. If you look at over here the table, the expectations are simply based on the past. There is no imagination left. If you look at the 1980s peak of $850, followed by the peak of 2008 hitting $1,000, then we had the 2013 peak of 1,920 and the followed peak in 2026, which was last month, 5,200. What you really want to pay close attention is how the crash percentage-wise progresses over the years. Sometimes the jump is greater than the followed pullback. Sometimes the pullback is greater than the previous run-up. And it is always a different reason in the economy, in the country, or worldwide that actually causing this pullback. If you look at over here, the first crash in 1980s was 65%, from making back then the new all-time high of $850 per ounce. The following crash of 2008 during the 08-09 financial bubble was only 30%. The 2013 new all-time high of 1,920 per ounce had another 30% pullback. The recent pullback was the greatest. We saw very clearly that we had the gold falling around 40%. And again, if we look at the numbers, if we look at where exactly the gold bottomed, in 1980s, from $850, the sell-off brought the price of the gold all the way down to $297, which is absolutely phenomenal. In 2008, the prices went from $1,000 per ounce down to $700 per ounce. In 2013, the prices went from 1,920 down to 1,180. Again, it's still very heavy sell-off, considering that no one is actually holding, $1,000. People were invested big time. The current levels, as we look at it, could go down. Wall Street expects probably one of the worst case scenarios if we use the same correction. If we use a little bit above average of 30%, around 40% crash, this means that we follow the same trajectory and the same pattern. Wall Street thinks that we might be looking at around $3,100 at the bottom price. And remember, this is very interesting because in the previous videos we went through and we look at on the actual analytics, and analytics show that the fair value price of the gold, where the actual supply and demand makes sense, is around $2,000. So this is why even the most bearish people are, talking about $2,000 to be the fair value, to be the number where, the risks associated with, potential losses or overpaying for the gold might be, lowest. Still, everything is speculation. If you look at the years that people have been waiting after every single cycle just to break even. In 1980s, people who bought at the top waited 25 years. And the reason for that crash, if you look at over here, was the rate crash, right? It was a substantial change in Fed policy, which triggered a completely different interest from the investors on the market. In 2008, after the financial crisis, there was a major liquidity panic. No one has had actual cash. All of the funds were kind of invested in one way or another to the real estate market, which crashed. Remember, they have to print money, they have to bail out a lot of the banks, and things were very, very ugly. It took the people to break even 3 years. Imagine you wait 3 years just to break even. In 2013, we have a quantitative easing, again, change of the Fed policy. Obviously, the Federal Reserve is always more or less involved in the crash. This is interesting because people here waited 4 years to break even on their losses, the unrealized losses. But this is also a very long period of time. Imagine you're buying today at the peak. How many years you think you've been waiting? Wall Street thinks that if the gold actually crashes 40% in 2026, the prices cool around 3,100 or so. Wall Street thinks that people might be waiting 5 to 20 years just to break even. And the reason for it, again, Kevin Walsh, who will improve the dollar index DXY, who will improve the dollar value, and will focus on hawkish Fed policy, which is extremely bad news for gold and silver. And you will be looking at if this align with BlackRock and Vanguard. If you start seeing they're sending messages to their clients, BlackRock and Vanguard are sending messages to their clients, we advise you to, move funds away from gold and silver at this very moment. We advise you to put money here or there. When you start seeing people reporting on X, receiving such kind of email from their asset managers, you understand it's over, right?